Markets are really tough at the moment, and sometimes it can feel like you're hitting your head against, well, a soccer ball. This rally in US equities, and particularly those four stocks I highlighted to you yesterday, including those two Australian miners, BHP and Fortescue, because they are global brands, Apple, Tesla, they just failed to impress in New York trading yesterday in the Thursday session. We'll see what they can do in the Friday session, but I've got to tell you, I think we're still in troubled waters. It certainly feels like all the good news is priced in. It even feels like all those who wanted to buy the dip have done so. It was certainly a big bounce, massive rally in US and Australian equities. But again, I have to make the point, proportionately to the losses we've seen, it was only, sort of 30, 50, 55% of the way back up and stalling. I've used that word a lot lately because that's the big risk we have to watch for, is that markets stall back in on themselves. That could have, well, how do I say it without being too sensationalist, but it could have a major sell signal for a lot of those longs out there who are hoping this buy the dip scenario is actually going to continue to play out. Now, if those people begin to panic, the market's going to have a lot more downside, and hopefully not spectacularly, but it could be. And spectacular downside is what can really hurt. But if you're on the right side of it, then you're going to have the opportunity to be empowered for the subsequent rally later on. The reason I keep pushing this is I am actually concerned we could have a 3 to 6 month correction phase in equity markets, both in the US and Australia. Sorry, I'm trying to keep the mic out of the wind. In economic data, it's pretty poor. US data yesterday was really worrying. Some indicators on manufacturing, services were well down. In fact, you might say, I'm trying to have my back to the wind, you might say they were collapsing. Actually, you could say they were collapsing. And really worrying was new jobless claims, which moved well up again for the second or third week in a row, and are 70% higher than pre-COVID levels. In other words, 70% more, nearly double, well, I'm exaggerating of course, the number of people are losing their jobs at the moment. That's what everyone's sort of missing the point. There is still an enormous number of layoffs in the US, and manufacturing's collapsing, services are collapsing. We know the property market is tiring, and the housing industry is really well and truly rolled over. So the US economy is by no means in a good condition. We know China's slowing dramatically, and we know that iron ore's down 60%, but for some reason a lot of equity traders in Australia still think, and I hear it said, even around by some leading commentators, that the US is having a strong recovery phase. No, that ended several months ago. It's actually in a diabolical state. No one's saying it. And that's why I think there's this disconnect that's intensifying between the real economy of the United States and equity pricing. And we've gone into how that's zero interest rates, and we've gone into how that's also a safe haven trade, the rest of the world buying the US dollar and US stocks. On the US dollar, it does seem to be the case that when it goes risk on, buy equities, people sell the US dollar. And then when they go risk off, they buy the US dollar, sell equities. That's creating a bit of volatility in markets like gold and oil. But gold, I'm almost at the point of having to apologize to you. It's sitting on some important support here. If it goes much below 1730, I think it is, then it's going to look a little bit bearish for a while. As I said, this is a long-term, big quantitative kind of consolidation pattern that I'm looking to break higher, and I'm not expecting, I was never expecting the market to immediately run to $2,500 US dollars gold, and I think I've been very clear about that, but I think you can steadily accumulate gold, and if it has a run to the downside, that'll just be a good level to accumulate a little bit, but just be more patient if that happens, if we break that support. Otherwise, if you start to see an uptick, I actually think what we're going to see in Friday New York trading is US equities come under pressure and for the buying of the US dollar to resume. So I am bearish the Australian dollar, I am bearish euro, I'm still bullish sterling Australian dollar. I think that's a good cross. It's come back to support a little bit, but I think that will be good in the long term. Oil, I said, could run up another dollar or dollar and a half. It has, could run a little bit further, but long term it's probably a sell. As I said, those big four stocks, Apple looked heavy all Thursday trading, Tesla looked heavy all Thursday trading, but those levels I gave, 755 for immediate break higher, 760 for Tesla. If it breaks up through there, Apple 149, then the bulls have a winning argument. While those levels hold though, I think you have to be very careful of significant downside in equities in the US and in Australia. And in Asia today, economic data wasn't good either. New Zealand's trade deficit just went through the roof. It's an absolutely whopping, hugely horrific number. That's not good. In Japan, we've seen some economic indicators there slow down quite significantly. It's not been a good day for data in Asia either. It wasn't a good day for data in the US. So that stock market rally looks particularly vulnerable. Oh, and sorry, I have just one more thing to say. Tim Cahill, eat your heart out. Skills. Have a great weekend, everyone. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.